Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market site, we have Michael Normyle, U.S. Economist at Nasdaq, Max Cabasso, Managing Director on Nasdaq's Market Intelligence Desk, as well as Justin Grooms, CEO of Bolt, and we're here to discuss the strength of the consumer, certainly an underlying factor in the economy. It is great to have everyone with us. Welcome to Trade Talks. Justin, before we get into retail performance in 2024, give us some background around Bolt. What's the type of data that you're looking at?
Yeah, absolutely, and thank you very much for having me here. So I'm Justin Grooms, the CEO of Bolt, like you mentioned. Bolt's been around for about 10 years, and we're the leading checkout technology provider in the United States primarily. Over that entire period of time, we've had the ability to, through the 80 million different consumers that are in our network, see purchasing behavior evolve over the decade. And it also allows us to see a real interesting trends as they emerge each year and year over year. So we can see through our hundreds and hundreds of household brand merchants what the purchasing behavior is on a macro level for all of these different types of consumers.
Which is so interesting because you have this proprietary data to extrapolate some really interesting ideas. So when you think about retail performance in 2024, what was the biggest shift?
The biggest shift that we saw that was very interesting and is really only an insight that I think you could get if you had a data set like ours, is a movement for consumers towards a more emotional purchase. I think that we had a year where there was a lot of uncertainty, that's our theory at least, and so people were going towards buying things for themselves that made them feel comfortable. This is different than what we saw in previous years, where we saw people going more for value, essentially, or to solve problems that they had in their household. So we can see those little trends, and that helps our merchants to adjust how they merchandise to their consumers, to their customers, and provide things that are relevant to them. And that's been really interesting.
That is really interesting. And Michael, when we think about it, it's just really been hard to bet against the consumer as they have hung in there despite the pandemic, a lot of uncertainty within the marketplace and economy, and they continue to spend quite well heading into the end of the year.
Yeah, and it makes sense when you have the 2020 hindsight. Obviously, early on in the pandemic, you had enhanced unemployment benefits, you had stimulus checks, all those things that made it easy for people to keep spending. But then that money also helped people get through that high inflation period. Once we got past that and the labor market stayed tight, you saw wage growth above the rate of inflation. And so that positive real wage growth that people were getting, that's been really the source of funding for the most part that people have been using the last couple of years here. And then on top of that, if you look at kind of a wealth effect where the stock market's been doing well, if you own a home, that's probably gone up in value. So there's a lot of different things that are making people feel wealthier, and that tends to help people keep spending.
Yeah, Max, it's almost like you have to have a recalibration in terms of how you think about spending. I mean, January is what, 5 years since things really started to change with COVID? I mean, that's not that long of a time span for all of those machinations to take place.
Yeah, for sure. Another thing that we talk about frequently about commuting, coming to the office, those sort of costs, when they're gone, kind of adding onto that is you have that additional capital that you used to spend to get into the office, buying your lunches, whatever it might be. So it's, again, even more that's available to most people that have a hybrid office or working from home, so they have additional parts there. But we talked about it a year or two ago about kind of the bifurcation as well of different types of consumers, those that the haves and, hate to say haves and the have-nots, but if you're invested in the stock market, you've seen appreciable gains that you can then use to go out and spend. But if you're not invested, if you don't own a home, if you're renting, those costs go up. So I'd be interested to see kind of the split of, obviously we've seen credit continue to go up, not at a huge pace, consumer debt, for credit card debt, delinquencies aren't up though. So again, people are finding ways to spend. But again, it's just, you kind of have, like you said, change the way you think about it and kind of who's spending what you're spending on, say to yourself versus travel. And you see it after the Fed today with the dollar. Are you going to, traveling more potentially, other countries? And again, the breakup between the U.S. and global. U.S. is a lot stronger than some, the rest of the world.
I just think it's really interesting when it comes to consumer perception. I was talking to someone the other day who said, perhaps with the new administration, the economy, the market's going to get better. And I said to him, like, the S&P is up 28%, the Nasdaq is up 33%. For all intents and purposes, the economy is firing on all cylinders. And it's interesting, is there anything you can discern from the payments landscape or how people are shopping digital versus physical and their perception of the economy? To your point before, emotional purchases was almost like a relief purchase.
It is.
Things are not as bad.
Yeah, I think that there's a lot of interesting things that we're seeing from a payments perspective that's making us ask a lot of questions. The first thing that we're seeing is a larger proliferation of different types of payment methods. So people experimenting with the ability to pay directly from their bank account, which is interesting to be able to use a cash balance to pay. But at the same time, we're also seeing an uptick in the use of buy now, pay later. So short-term debt that people are focusing on individual purchases, as opposed to maybe just driving up on high cost.
What are your
credit
thoughts
cards.
on BNPL?
I think that the BNPL market it's very interesting. I've been recently learning from a lot of the BNPL leadership teams the different focuses they have on the different types of consumers. You have certain BNPL providers that are focused very much on trying to provide a sustainable, they would characterize it as, model of giving and pulling information from credit bureaus. You also have other BNPL providers that are not touching the credit bureaus, not reporting in and out. I think what's interesting about BNPL is we haven't felt if there's going to be a reckoning with it. We haven't felt if these little isolated purchases that consumers are doing here and there are going to add up to an unsustainable level. What's that uptick going to be? The second thing that we've seen changing over the last couple of years is a big shift. You talk about people going back into offices to purchases on Mondays. We're back to that movement of people are buying on their way to the office, when they're in the office, it seems, and a big dip on the weekends. But people are not purchasing on the weekends quite as much as we saw during COVID. And that's fascinating to me too, because it's what are they doing on the weekends that's not consumer driven, that's not e-commerce driven, that these retailers aren't seeing them, and what are retailers going to do about that?
Which is interesting, I mean, because we had nothing else to do on the weekends, right,
Yeah.
during COVID. But I also think, I know anecdotally, having things on a schedule that are delivered, you kind of set it and forget it for Chewy or whatever to have it delivered. Anything, Michael, that you're seeing from economic data to give any insight as we head into 2025 regarding the consumer and their preferences? It doesn't feel as much has really changed, which is why, you know, Fed rate policy is going to be interesting. Is it really necessary to do cuts or prolong it a bit?
Yeah, I think the challenge that we see going into 2025 is that, you know, the wedge between wage growth and inflation looks like it should be getting smaller in 2025, so that positive real wage growth won't be quite as strong. It should still be positive in 2025, at least the early part, but that means, you know, you can increase spending, but not as quickly as you were able to do it in 2024, if that's what we see, because the labor market, it's been normalizing, and inflation's really kind of plateaued lately. So if that comes to pass, then that means wage growth is going to slow a bit, but inflation's probably not going to budge that much. So you're going to see a little bit weaker wage growth in real terms, and that allows spending to grow, but not like what we saw this year. And then the other issue is that if you look at interest payments that households are making, a lot of people still, they kept their mortgage that they got a few years ago, but if you have short-term debt, if you have a car loan that you got in the last few years, that's going to be at much higher rates than it was if you got it 5 years ago. And we're, you know, what the Fed is showing today, they see rates getting to about 3%. We're not going back to 0% rates. So that non-mortgage interest rate cost is going to stay an elevated issue for households. You know, it's going to be easing off a little bit with rates coming down, but not going back to that pre-COVID type of levels we saw.
The data around auto loan delinquency, that is a key factor because, as I understand it, the last thing that you want to default on or have to default on is your car. So if you see an uptick there, that could potentially be a sign that there's some weakness on the horizon with the consumer.
Yeah, and on top of that, just cars have gotten much more expensive in the last few years. So you see, you know, anecdotal stories about people have had to trade down to used cars just because new cars have gotten so expensive. Plus you add financing on top of it at higher rates. But like Max was saying, the delinquency rates aren't too worrying right now. But they have picked up. So you want to see that, you know, plateau or even turn back down, hopefully in the next.
And you've made this point a number of times when it comes to the unemployment rate. If it goes from 4.1 to 4.2, okay, that happens. If you start to see, you know, a number of deviations, that's when you get concerned. So it almost sounds the same way to me. Max, so, you know, on the Market Intelligence Desk, you are dealing directly with management teams of Nasdaq listed companies. Is there any trend that you can discern as they think about 2025? Because there are a number of outliers in terms of what their structure is going to look like from a tax perspective.
Yeah, I think there's a lot of hope, especially in tech, that a lot of regulations are going to come off. Innovation will kind of speed up, is the hope. The only thing with the market, especially right now, is we've talked about how well the market's done this year, but especially recently breadth has been really bad. You're starting to see the S&P outperform. I think so far month to date, S&P is outperforming equal weight by like 4.25% already, which is the 5th largest, I think, over that time period ever. Since the equal weight started in 1990, growth is outperforming value again. So you're really seeing the flight to safety trade now, which is going into these mega cap names, is really carrying the market, which is kind of a backwards thinking. You're like, oh, safety going to growth, but it's these mega cap names that can kind of get through everything, where some of the smaller caps, the 2000, that trade that seems like everybody's been waiting for, the Russell 2000, the small caps to really pick up and catch the mega cap as those start to slow down a bit, just hasn't happened. And I think that's been the concern. Everybody was waiting this year for rate cuts to start to kind of lock in their long-term financing instead of kind of rolling over the short-term, comfortable with the long-term. Again, the volatility's out, so they can kind of plan better. So in that sense, they're optimistic. And again, the questions about regulation, are they going to be able to innovate? Is that going to come off? I think that's pretty well baked in. So there is a lot of optimism for the next year and the next few years, hopefully. But again, the trend of the growth really happening in a concentrated group of names and not really spilling over to the rest is still a bit of it's a warning sign potentially, just to keep an eye on that. If this keeps going, that's the safety trade, so more money is going to keep flowing to those big names.
Yeah, so Justin, let's talk about innovation for a moment here. How is data being used to leverage and impact commerce, whether you're talking about personalization or just in terms of how retail companies are managing their supply chain, their inventory, and so forth?
Well, we see the biggest use of data in our space right now is there has been a lot of innovation in the payments and the retail space over the last few years. But what there hasn't been is essentially a consolidation of being able to access and use that innovation in a really easy way. An example that a colleague of mine likes to give is if you think about streaming apps, it started off as this great convenience to do away maybe with your cable bill, but over time we can all, I think, reflect to sitting at home and thinking if we want to add that one more application, if we want to add that one more subscription, if we want ads or not ads, and all these decisions that we have to make. In the payment side, we have seen no real innovation in consolidating payment types into a usable format for consumers. And that's what a lot of the merchants that I talk to are asking to solve for, is consumers want to use different types of payment methods, but they also want it to be accessible and they don't want to have 30 different passwords and accounts that they manage everywhere. I think that what we're seeing is that we're able to apply data that we have, and I think other people in similar situations, to help inform consumers and merchants and retailers of what the best payment types or shipping methods or whatever might be for them in that.
But it gets confusing though. How do you spread out, all the loyalty programs and where you get free shipping and I feel like, to your point with the cable companies, and we've been through this before in the early 2000s, with cable bundling and so forth. How do you, I guess there's no answer for that, but how do you prioritize how you want to spend, where you want to spend? Because if it's spread out all over, you're really not reaping the benefits of loyalty programs.
I can tell you what I'm hearing from large household brands is that they are concerned that they don't have a crystal ball to tell them what's going to come in 2025 and 2026, and they need to be prepared for, is loyalty going to trend over time towards more store or brand specific, or are there going to be cross-brand loyalty schemes that develop and get more traction? Are different payment types going to narrow down or expand out? So they're investing right now in creating that optionality for themselves, implementing platforms that allow them to integrate with different types of loyalty programs, integrate with different types of payment platforms, or BNPL solutions, whatever that might be, so that they can be ready and agile in the future for what might come.
What about the fusion of digital and physical retail experiences? Being a kid from the 90s, I worked at Foot Locker, Champs. It was everybody wanted to work in the mall. Everybody hung out at the mall. Like, that was your social structure. Clearly it's different now. And the pendulum really went to the digital side. Is it coming back to the middle? Are you seeing any fusions there?
Absolutely. It's absolutely a priority with the merchants that we talk to. It swung during COVID all the way to the digital side, almost in a militant fashion. And what we're seeing now is that visceral experience that consumers had in stores, they want that still. We're seeing large brands that are opening up small bespoke stores that tailor to neighborhoods or tailor to appointments or help facilitate returns in a way that can maybe capture a sale afterward. We're also seeing that consumers expect there to be a seamless flow between their identity online and their identity when they walk into a store. So that if you recognize me online, I expect you to be able to recognize me in store. This is what Starbucks has kind of conditioned us all to believe on the app,
Starbucks at the
right?
local
That
locations.
you can walk in and you get the drink that you want, and you expect anywhere in the country you'll get that same
Yeah, which makes it
experience.
interesting for inventory management. One of my favorite stores, they only have regular sizes. I'm short, so you can only get the petites online, right? So you can't try things on, it's only available here, so then you have to think about the whole inventory management perspective as well, and I'm sure the insights that you get from Bolt certainly help them to make those decisions. But Max, you and I live within proximity to the Short Hills Mall, and a lot of those stores there, you've seen them transition, especially out of COVID, like the Tesla store as an example, Peloton, how it's an experience you could touch, you could try. It's almost like a lounge and you can hang out.
Yeah, I mean, I use it for my kids, getting them baby clothes, going to a corridor type thing.
Yeah.
It's funny, I was driving by the Short Hills Mall last weekend, and the line was backed up outside, on the highway, waiting to get into the parking lot. I was like,
Haven't seen
what is
that in a
going on?
while.
I looked over, I was like, wait a second, this is Short Hills Mall. There's a lot of people going in. But you're right, you kind of want the same experience online and in person, but being able to be there and actually physically touch it, I definitely have started to see that coming back. Myself, my wife, kind of going more towards the store. Even with quick shipping from like an Amazon with Prime, sometimes you need it that same day, and being able to go to a store and actually getting it, like, I need this now, I expect you to have it, and when it matches up and the store actually has what you're looking for, the same thing you have online, it's that seamless transition. You're more willing to go back. So I've definitely seen that pick up. Again, it's more anecdotal, but you mentioned Short Hills. I saw it definitely last weekend. It was
Well, I
wild
think
to
people
see.
just want to get out of the house and reassume some sort of social construct there, but rather than have to fit to the mall, there's an experience, and it's not just department stores, but there's different types of anchors and experiential, different ways to interact. And do you think that's going to continue to be the trend, or it's just an anomaly?
I think a very specific example of what these large retailers are doing, especially that have big omni-channel either ambitions or existing footprint, is they're helping to inform their consumers online to understand what they might expect when they get into a store. This can go from a very simple thing of saying, these are the sizes that are available in our location, to saying, we might not have the specific size of the item you're looking for, but we have that size and a different related items so you can try it on. We see a lot of trying to unpack that with retailers, because the dream for them still is to get you to walk into the store, develop an emotional connection with their brand, and then the next time they need to capture you, either physically or online, you think of, I just want this experience, I know what that is like, I want to go there, I know what to expect. This goes a little bit back, some of our retailers think, to the perspective of people want a little bit of certainty right now. They want to understand, going into a store, trying something on, lets you know what to expect, lets you know what you should get, and I think that is going to be a trend that we see, I hope, grow a lot in 2025.
All right, appreciate everyone's insight. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.